Hello, everyone. Welcome back to SEC Roundup. My name is Tom Zaccaro. I'm a partner in the investigations and white collar group at Paul Hastings. With me, as always, is my partner, Nick Morgan. Hello, Nick.
Morning, Tom.
And we are delighted to have a very special guest today, Dan Gallagher. Dan is the Chief Legal Officer of Robinhood and previously served as a commissioner of the SEC from 2011 to 2015. Welcome, Dan.
Hey, thanks for having me, guys. Happy to be here.
Oh, honored to have you. So we have seen over the last year or so a very aggressive rulemaking agenda from the SEC and Chairman Gary Gensler. And one rule he has talked about, but it hasn't proposed yet, has to do with meme stocks and an outgrowth of what we saw 2 years ago, early in the COVID pandemic, when meme stocks were going crazy in the market. Nick, do you want to talk a little bit about what Chairman Gensler has proposed?
Yeah, and to be clear, Tom, there's not a proposed rule yet. So we're talking about a potential proposed rule, but to rewind a little bit, as you said, we all lived through, during COVID, the meme stock craze, or whatever you want to call it, but we're individual retail investors were investing in stocks that came to be known as meme stocks. And we saw some volatility, we saw some price rises, we saw some phenomenon that were unusual. There was, in response to that, political pressure from Congress and elsewhere for the SEC to do something about it. And one of the things that Chair Gensler did was to have the staff look into what occurred and report back. The staff did that. In my view, the conclusions were not all that helpful, but that report was out there. The pressure, I think, to do something is still exists on Chair Gensler. So in a fairly recent speech, Chair Gensler talked about the potential of proposing a rule that would really fundamentally change sort of the plumbing of the way trading occurs. And if this rule gets proposed, one of the things he talked about was requiring that market orders be sent to auction, which would be a very different way from the way trades are handled today. So that's what we want to talk about is that potential proposed rule, Tom.
Dan, you have a perspective on this, both as the Chief Legal Officer of Robinhood and also as a former commissioner. We'd love to hear your perspective on what Gensler might do and whether it's a smart thing for the markets.
Yes, so happy to weigh in on this. I've weighed in a little bit publicly. I like the way Nick sets it up, right? Drawing a line actually between the events of January, 2021, the GameStop events, and this proposal, and this sort of rush to do something, or this impetus coming from Congress or gadflies or whomever to do something, I find really interesting because, again, I don't accept false predicates, and when I hear discussions about this rulemaking and it being related to January 28th, it kind of makes me laugh. There's this narrative of January 28th like it was some big market structure issue. What happened on January 28th is that there was a huge run up in volumes, mostly on the long side and retail brokerages. The NSCC collateral requirements required more collateral than a bunch of firms had. Robinhood included, within a 2-hour period early in the morning, the DTC properly waived these requirements because they made no sense because, and I can only speak for Robinhood, but most firms, as I understand it, had 100% margin requirements on these securities. So there was cash sitting in the 15C3-3 account, offsetting any liability at the clearinghouse, and therefore I would think, using logic, negating any chance that we're going to blow up and provide risk to the clearinghouse or its members. And so it actually was, much ado was made about all of that very technical stuff. And if you really wanted to dive into a rulemaking, you might think about a way that 3-3 funds that are locked up could be applied to clearinghouse deposits. They're the customer's money, right? And if they're to offset a customer liability, which is the purchase of a security, why not match them up? Why have the broker act as a middleman fronting collateral during the T+2 period that it currently takes to settle a trade. So we saw some good stuff, right? And Robinhood, led the way. Vlad Tenev, my CEO, led the way on the clearance and settlement cycle. So, T+2 is kind of silly. Now you see rulemaking on T1. That's a great thing. But then you hear these other, quite frankly, I think silly ideas of gamification of brokerage apps caused this, or the market structure and market makers and lack of competition caused this. Payment for order flow caused this. And it's garbage, guys. It's not true. It really falls squarely into the bucket of don't let a good crisis go to waste. And, I lived a lot of my life on the commission dealing with the remnants of not letting a good crisis go to waste, also known as Dodd-Frank. And, I lived through the crisis in trading and markets, and Dodd-Frank didn't resemble a lot of that to me. So, but here we go again. As I said, as Ronald Reagan said, there you go again. And we're dealing with this false impetus to regulate on this proposal itself, or this idea of a proposal, whatever it may be. I mean, it's kind of hard to argue against order by order competition. That's what Chair Gensler talks about. Sounds really good. I think one thing people forget or don't see, because it's not obviously in the public realm, is that the way we execute orders at Robinhood is we take in your order from the app and we shoot them out to market makers who actually do, in a strange way, compete for that order flow. Our order router looks across the 6 or 7 market makers that we have relationships with. It determines who has done the best on that size order in that issuer over the last 30 days, and it sends the order there, right? So whoever's giving you the better execution, the order goes there. That is competition, right? So the idea that now we need to interpose a national securities exchange, and I'm a big fan of NASDAQ and the New York. I think they do great work. They're not exactly known as bastions of technology and high, efficiency trading, but to interpose them between the retail brokerage firm and the market maker with the idea that things will get better, I think is quite silly, actually. So how this works, we'll see. There's this layer of best execution, an SEC best execution rule on top of that, which is kind of fascinating, right? That's something, quite frankly, some of us have been calling for over a decade. It would be nice to have an SEC best X rule so it's not as gray or murky an area. As you both know, there's a FINRA best X rule. Kind of interesting that we're not talking about FINRA updating its existing rule, especially since we kind of gave broker-dealer oversight mostly to FINRA when Mary Jo was chairman. But put that aside, there's going to be a new federal, I'm not going to say federal because I guess FINRA is technically federal, but a super federal rule on top of the SRO rule. It's going to be meant to complement whatever this proposal is on auctions. And at the end of the day, I guess we're led to believe that executions will be cheaper, more efficient for customers. Call me curious on that. I'm going to wait and see.
And thank you. Those are terrific insights. Really appreciate it.
Happy to
Well,
be
that's it for this episode of SEC Roundup. Nick, Dan, thank you very much. And we'll see you all on our next episode.